Again, it is something of an industrial because companies are going to continue to advertise, continue to market. So while their spending may decrease, it's still going to happen, right? And I think I've said it before. It's almost like a commodity, meaning that something is going to have to really happen with demand before you start seeing lots of um, ad agencies lose a lot of money, right? The other thing I want to mention here is that I did mention Starbucks in the previous video, but it is not investable for us because the dividend has fallen below 2%. As you can see here, dividend is currently 1.89%. So we cannot invest in Starbucks. That's just not going to work for us. So again, this is going to be fairly easy for us as we only have to choose between IPG and OMC. GPC is the sector leading performer. I'm almost certain that if the price was not so high, it may even be on the list of sector MVP. But again, because it's not investable for us, it is not on that list. So this is going to be really straightforward because, like I said, both of these companies do the exact same thing. So it'll be very easy comparison, okay? As you can see, the dividend is the same. So there's nothing to be said there. The only thing that I'll say right now, though, about these two is the price. So IPG, which is sitting at $36 right now, it's going to be a lot easier for us to purchase 100 shares of this particular company and to potentially sell some options against it, or even to sell options to enter into a position with IPG. Whereas with OMC, the idea of us purchasing 100 shares may or may not work. I'm definitely going to have to throw that into the equation and see, what comes out of it. But as of right now, it looks like IPG would be definitely an easier position for it to get into. All right. The PE is about the same. IPG is a bit higher, meaning that the stock itself relative to OMC is a bit more expensive. But again, those two numbers are very close to each other. So I'm going to call that about even. The big difference that I do see here is the 5-year high, though, right? So at some point, IPG ran all the way up to almost 45 PE, whereas OMC has only gone up as high as 20. What that typically means is that at some point in the 5-year past, there was a lot of excitement coming out of IPG. Either that or the price went really high and earnings stayed really low. Or maybe it's possible that, earnings dropped, but, the price didn't move, right? And again, that just goes back to how people feel, how the market feels about this particular company. Typically, when earnings drop, you'll see the stock price drop as well. But if earnings drop and the stock price stays the same, that means that the market is saying, well, they lost a little bit of money this time, but we're sure that they'll make it up, right? And then the other side of it is, or maybe earnings don't move at all. Maybe they're making the same amount of money. Nothing has changed. They haven't done anything different. They haven't done anything better. But for some reason, people bought this stock in droves, right? And it drove the stock price up really high. Earnings stayed the same. That'll also cause the PE to increase like that. So again, it's just about sentiment. It's just about how the market feels about this particular company. And based on this 5-year number, it appears that the market tends to like IPG over OMC, and that plays right into exactly where these companies fall on our list of portfolios. Whereas OMC is in the standard deviation portfolio, meaning the stock price is not going to move around a whole lot. You're not going to lose anything. It's not going to make a whole lot of anything. Whereas IPG is more in the alpha portfolio, meaning when the market is doing well, the stock is going to really do well. All right, 5-year low is even, so nothing really to say there. The average PE, of course, is going to be higher for IPG just because over the last 5 years, like I said, the PE has been higher for those guys. Interestingly, though, it looks like IPG is actually the PE is less than what it has been on average, meaning that if sentiment remains the same, this stock price has potential to move higher, whereas OMC is right at its historical average, meaning that if all stays the same, the stock price will just stay the same. And again, it goes right back to where these companies fall in their respective portfolios. OMC is not going to move around a lot. IPG has potential to move pretty high. All right, net profit. Looks like OMC is doing a little bit better on net profit. IPG not so much. But again, these numbers are very close, and so right now I'm going to call them similar without doing an in-depth analysis. I'm just going to say they're about even. Same thing with return on assets. I don't imagine that management is going to be much different between these guys. Looks like numbers are about even there. Cash per share. There is a bit more cash on hand with OMC. We talked about that in a previous video with some of those M-score portfolios where companies have a lot of cash aren't doing so well right now, right? So I think right now the market is looking for growth, and that's kind of, again, reflected in, like I said, so it's important to note OMC is the sector leading price performer, okay? So the price is actually performing better over the last 12 months than IPG. Okay? IPG just happens to be included in the best performing portfolios, but not much more than OMC. So again, these guys are fairly matched. And again, 23 versus 30% is almost 10% different. And so again, we look back at, typically again, when there's more cash on the books, that's better because it means that the stock price is made up of more cash, so it's more stable, it's a safer bet, and is, again, without doing an in-depth analysis, it's possible that having less cash on the books means that IPG is growing more, okay, which may really be what's going on. All right, cash to debt. Looks like IPG has less debt than OMC. Again, that is something that's typical of a slow growth versus a fast growth. It may have something to do with age as well. Older companies tend to have more debt and less cash, whereas younger companies tend to have more cash and less debt. And so, again, not a huge difference, but at this point, we have to look at even the small differences if we're going to make any sort of determination here. Here's a big one. This is short interest. Okay, so again, this is market sentiment, right? So there is almost double, well, not quite double, but almost double the number of people that are betting against OMC versus the number of people betting against IPG. Now, in a situation such as this, what I love is a short squeeze. I love short squeezes because short squeeze means that there's a lot of people betting against this stock, and then you have someone that, is betting for this stock. And that is the quintessential definition of a market, right? Is you have conflicting ideas, you have conflicting data, and people bet against each other, right? Now, what happens in a short squeeze is that as the price continues to go up, right, it can go up infinitely, meaning that those who have shorted the stock can lose an infinite amount of money. And what happens is that the brokerage that you're purchasing or selling this company through will call you and say, hey, this stock price has moved up so much, you need to send us more cash to cover this, right? And so to the downside, however, when you have someone that's betting for a stock, the stock price can go to zero, but you're only going to lose what you put into it. You can't lose any more than that because zero is the floor. There's no such thing as a negative stock price. So again, when you're shorting or when you're betting against a company, as the stock price moves up, it can keep going up. There's no limit to how far it can go. And so there's no limit to your losses. And so what happens is as that stock price moves up, you have a lot of people that have been shorting this company, have been betting against it, all of a sudden have to then buy the company. Because remember, there's only two things you can do. You can buy or you can sell. If you buy first, then you can sell later for profit, right? If you sell first, you can buy later for a profit. But if you're selling first and the stock price goes up, when you buy it, you lose money, but you buying it also increases the stock price even higher. And so with short squeezes, it's really awesome because what happens is the stock price moves up sometimes just a little bit, just enough so that all those short sellers have to cover because they're afraid of losing so much money, and then they end up buying the stock. So now you got excitement of people just buying it regularly, but then you got the people who's been short selling it, buying it even more, and then the stock price just like goes up and up and up. Crazy. And I love those short squeezes. In this particular environment, in this particular sector, I don't imagine a short squeeze happening anytime soon. We know that the consumer cyclical sector has been performing fairly well, but is there any sort of like real turnaround or any real like great big thing that's going to happen specifically with this company, specifically in the ad agency space? I don't know, honestly, but also it's hard for me to imagine. Okay, so I don't think betting on a short squeeze is a good idea right now. And so, with that being said, I have to look at this short interest and say that it is a negative for OMC that there are so many people betting against this company versus people betting against IPG. And again, that goes back to that PE ratio. Historically, IPG has performed really well. People have been excited about it. And so people are going to be less likely to bet against it. Another thing I want to say about this, we know that the beta portfolios have returned the most money over the past 12 months. And I don't mean the most money overall. I mean the most money per month when they did perform well. Okay, overall, the beta portfolios have not performed well. But in any one month, if you can pick a beta portfolio, if you can bet against the stock market in any one particular month, you stand a chance to make a lot of money. And that may be what's going on as well with OMC, where you have people that are betting against the market because, like I said, sometimes it works, right? And so this may be just be an artificial number based on the rest of market dynamics. Not necessarily this particular company, but just because there may be more people looking to short the market, period, right? And so being that IPG, again, has such a high PE, it makes more sense to short something like an OMC versus an IPG. But again, with all that being said, I still have to look at this as being a negative and go against this higher short interest here. All right. It looks like IPG is a bit off its highs, but again, 10 versus 7, not a huge number. IPG is further off its lows, but again, 43 versus 39, not a huge number. I do think these numbers do really make a difference though, right? Now, again, we're talking about 0.00, right? But even then, it's a fairly large percentage difference, right? So IPG, even though their alpha isn't positive, okay, it's still less negative than OMC, meaning that this company has a lot more alpha in it, meaning that it's going to perform better when the market performs better. The up moves, this again means that when there is a lot of activity, when there is a lot of buying and selling, these companies tend to price moves up more than others, okay? And it looks like OMC beats out IPG by a little bit there. Why that is, I don't know. Maybe it's because OMC has been a safer bet, and so instead of there being like maybe people's, I don't know. I think maybe OMC is just a safer bet, so maybe that's why they beat them out. Same thing and the down moves. And this one makes a lot of sense, right? When there's a lot of buying and selling going on, it looks like OMC stock price tends to move down less than IPG. And again, that falls right in line with what volatility, standard deviation type of portfolio is going to give you. All right, here's another interesting thing, okay? The beta. Now, like I said before, the beta portfolios have not performed very well, but if you can time it, right, you can definitely make a lot on these beta moves. And so we see IPG has a fairly decent advantage over OMC as far as beta. Now, what that means is that when the market is, going the opposite direction, that's not going to bode well for IPG at all. But you pair that with the fact that the alpha is also better than OMC, it just means that price performance compared to the rest of the market is going to be better, period. The next thing is a big one, is the 1 month return. Again, this is double OMC. And so we're talking about the past 3 years, okay, not counting the last 6 months, okay, but over the last 3 years, not counting 6 months, IPG has returned double what OMC has returned on a monthly basis. So again, it's just a much better price performer, even though OMC is outperforming IPG currently. All right, volatility. Again, this is going to be risk. Of course, we expect the risk to be lower for OMC. We've already talked about that, but I don't know if this is such a huge difference here. I really don't. 289, 225. I mean, it's definitely a difference, but not a huge difference. And so, because of all that, the score for OMC is higher than IPG, which is why our portfolio is calling for OMC. But again, when looking at the literal number difference, I don't know if 2.8 and 2.2 or 2.9 and 2.3 is such a huge difference, as far as volatility and risk goes. And then the M score, of course, we talked about the cash on hand is much better for OMC than IPG. But again, we know that those M score portfolios have not worked very well. So I'm going to look at this as a negative as well, even though I more prefer companies with a larger management score, because it just shows you how well the management is managing the company, right? How are they reducing the debt? Are they getting a better return on assets? How much cash do they have on hand? Those types of things. But again, like I said, we know that the M-score portfolio companies have not worked well. So with all of this said and all this looked at, again, without doing an in-depth financial analysis, which I don't think is really going to be necessary right now. I mean, everything points us to IPG. I think there's a higher potential for profit to be made in the company, even though we do stand the chance and risk of losing more than what we would if we were to go into something like an OMC. Again, we talked about wanting to improve the volatility and our risk profile, and I think this is a good opportunity to do so. Both of these companies are doing the same thing. Both really outperforming within the consumer cyclical sector. Definitely not retail, like mentioned before. And so I think that has a lot to do with it. They're definitely more of industrial type companies than they are consumer cyclical, because there aren't really consumers paying these guys. They're big industry companies paying these guys, right? Let's see, what else I want to look at? Oh, let's look quickly at what type of position we can open up with this thing. So it looks like, wow, that puts us really low. So let's increase this to 5. So it looks like even at 100 shares, let's increase it to 10. Is it right? Why is it still showing? Let's make sure this thing is calculating properly. No, it's not. Okay. There's something going on. Not sure what. Put some buttons. What happened? I think this may have something to do with my updating the prices. Now let me just plug and play right now. Definitely have to go back, change this. So just to explain what's going on, since I'm just sitting here. So I'm using a mathematical solver, okay? And what this thing does is that it figures out exactly how many shares of each company we ought to have in our portfolio to get us the best standard deviation score it possibly can, okay? And so right now it's giving us a score on the standard deviation chart of negative 0.02, which call is much lower. So OMC is 0.225, right? And so right now, our total score for all of our companies in our portfolio comes out to 0.02. But what we have to do now, though, is we have to go in and we have to change some of this, because as you can see, we have EMB at 171 shares. We currently have 200, so I definitely want to change that to make sure that it reflects what we currently have. There we go. Coca-Cola wants us to have 139. We have 100, so we can leave that there. Merck wants us to have 79. We have 15. We can leave that there. Paychecks, we have 20. Well, yeah. So the reason why this is not here is because this transaction was actually done in January. So it'll show up on next month's statement. But because we currently own the 20 shares now, I want to make sure that it gets calculated into our formula, give us an accurate. There we go. All right. So, and see, and that changed. So, yeah, so we're only down like 5% in paychecks. All right. So wants us to have 69 Southern Copper. Okay, 320 of Regions. We need to change that. So give that maybe 15%, something like that. Let's go up to 17. I think we can stay there. Okay, and then ETR wants us to have 100, and we only have 20. And we don't have any possibility of getting 100 shares anytime soon. So bring that down. All right. And so that still puts us with $570 left over. And the purchase price. Price is 36. And so we just have to remove some stuff. I think Regions Financial. There we So, what this means is that if we were to get 60 shares of IPG, we'll still have cash left over to purchase 80 more shares of Rogers, which we're not going to do. I mean, at the most, we'll purchase 40 more shares. We'll have cash left over to purchase 7 more EMB, 39 more Coca-Cola, 50 more of Merck, which is not going to happen, 50 more of Paychex, which is not going to happen anytime soon. We know that we're definitely for sure, within 10 days, I don't think the price is going to change that dramatically. We're going to sell out of our Southern Copper. We'll only have 30 shares versus 130. Program is only calling for 70. So we're in good shape. And so I think we can very easily move this to 100 shares. And that will give us the possibility of selling an option to buy those 100 shares. The only thing that I'm concerned with right now, as the way this is set up, is what is going to happen next month with MPW and Regions. I definitely want to make sure that we have cash on hand to purchase more shares if needed. And so, we were in tight cash restraints for the last couple months, and we've come out of that. And so I definitely don't want to go back to being cash strapped. And so I'm definitely going to be cautious about how we move forward. But 100 shares at $36 is $3,000. That's not a lot to put out right now. And like I said, that's not even spending that money right away, because we're going to make some money on the option, purchase it possibly at a cheaper price, right? And being that the PE has historically been so high, that means that there's a good chance that the options premium is also going to be high. So we can make more money to purchase the company at the current price of $36. We might be able to make like $100, $200 to buy it at its current price. So excited about that possibility. But yeah, that is the consumer cyclical sector.